Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent. Of course, I'm licensed in all 50 states, but I'm glad you asked. Welcome to everyone listening to us on all the major podcast platforms. And for all of you crazy people out there that are tuning in to the Fun with Annuities YouTube channel to see our facial expressions and our guest's stunning good looks. He is a repeat guest. In fact, he was one of the first guests on Fun with Annuities from the celebrity podcast series that I'm doing. And the reason he's one of the first, because he is one of the smart guys in the room in the annuity industry. And I want to welcome back the grand poobah who runs Canex, Gary Baker, the annuity dream maker. Gary, how are you?
Dan, good. How are you?
You know, Gary, I'm living the dream, living the annuity dream. Actually, I'm living the contractual realities, I guess you could say. But I wanted to get you back on because you have your finger on the annuity pulse, as they say. For just a little bit of background on Gary, other than him being a passionate Penn State University football fan, we are Penn State. Happy Valley, he thinks, is the center of the universe. I've had to try to convince him otherwise, but he just keeps pounding the table on that. Yeah. But he runs a company called Canex, C-A-N-N-E-X. And Canex provides the quote. So if you go to my site at theannuityman.com and you run immediate annuity quotes or deferred income annuity quotes or qualified longevity annuity quotes, that information, that aggregation of info is coming from Gary's company. They are a leader. I actually call them a monopoly, but they are the go-to source for those types of quotes. So they're dialed in to all of the carriers. You know, we pay Gary a huge fee for him to provide that service for us. No, it's actually really fair. He needs to raise his prices. And then, so, you know, when you want to get live quotes 24/7, 365, and you pull the quote up and then you just immediately say, you know what, Stan the Annuity Man, the Annuity Man. I mean, this is phenomenal. Gary's behind that. He needs a little bit of love too. So with that, Gary, anything new in Canex world? What's happening over there in the data smart people world?
Well, a lot. You would think the pandemic would have slowed things down. I guess we're coming up on the 24th month, right? Maybe 23rd, depending on your perspective. But it just seems like things are just busier than ever in the whole industry. So, which kind of blows me away a little bit. I think maybe because people don't have to commute anymore, so they're working while they're during that period of time when they used to be commuting. So I don't know. There's a lot of projects going on. There's a lot of new products hitting the market. You know, I would say like there's three big things that we see happening that we're responding to as a business, just as a as a function of what's going out there in the annuity market. But and we can dive into any one of these.
Yeah, what are the three? What are the three?
Well, I would say one is there is just a lot of activity of new indexed annuity products hitting the market, and a lot of innovation as far as different options and configurations. And and that's certainly that puts a lot of pressure on folks like you and other financial advisors who have to then figure this stuff out. So that's one. It's really increasing in a big way. So we can talk a little bit about
Why
that.
Is that? I mean, do you think that the combination of, I mean, we can call this the annuity perfect storm. You have 10 to 12,000 people hitting age 65 every day looking for guarantees. You have market volatility, even though we're in a raging bull market, you know, people like us who, even though we look dashingly young, we have seen markets go down and we have scars from those events. And I think people do too. So kind of the market volatility and the fact that people all instinctually know that it's a little bit high.
Yeah.
Do you think that's the reason you're seeing fixed products and indexed annuity products, which is a it's a fixed annuity issued by a life insurance company, is not a security? Do you think that's the reason you're seeing the tidal wave of indexed annuity stuff coming in?
I don't know. I mean, there could be a variety of reasons. I think the basic story may appeal to some people out there because, as you know,
Mm-hmm.
when you're selling a MIGA, right, the most simplest accumulation product out there, like a bank CD,
Mm-hmm.
you know what you're going to get. 3 years, okay, give me my 2.5%. And by the way, this year this could be going up, right?
Yeah.
Depending on the markets.
Let's hope.
Yeah, right. Knock on wood. Or 5 years. Give me my 3%. I know I'm going to get 3% after 5 years.
Right.
And because of that, as you mentioned, because of volatility, people may want to gravitate more towards that guarantee. But I think the appealing nature of an index annuity is gives you a little bit of your cake and eat it too. In that, well, maybe I just do a little bit better than that 3%
Right.
for 5 years. Maybe I'll have the opportunity to make 4 out of this fixed instrument as opposed to 3. But there's a likelihood I'll hit 4, 4.5. It's not a guarantee, right? So you could go below 3 potentially, but you're probably not as likely. You're likely to get maybe a few basis points, maybe a percentage more than
Right.
your traditional MIGA. And so that story, appeals to folks. And the way the insurance companies make that happen is that they give you these opportunities to pick a market index and then a formula that butts up against that index, which helps you keep score and just basically juices up the crediting of the insurance contract to give you a little bit more than that 3%. So when you think about it, it's a way to get maybe a higher likelihood of maybe getting a little bit more than that 3%, but you're not guaranteed for that to happen.
What's the innovations you're seeing? I mean, back in the day, because we were around in the 1995 when index annuities first came out. What's some of the innovations you're seeing other than different indices or index call options? Anything new that's head slapping?
So there's 2 things. One is, and I'll quickly go through both. One is on the fixed indexed arena.
Mm-hmm.
They're building new types of blended indices to increase the likelihood that you're going to hit that 4%. So if you think about an index annuity, just think about, you're going to the bowling alley, right? And so, if you're going to hit gutter balls, then you ask for the bowling alley attendant to put up those bumpers, on both sides. I think, maybe, I don't know, you might be a better bowler in that, Stan, but,
Well, a long time ago when I was drinking, I didn't care how I was bowling. So, yes.
So just imagine putting those bumpers up next to the gutters. And that's basically the index annuity is going to make sure that, if you hit the 7 pin on the left, you're not going to lose your principal, right? It's going to be, you won't lose more than 0. And then on the right side of the alley, where the 10 pin might be, there's a cap, depending upon how things score out. If I do well, I'll hit the cap at 4, 4.5 or something like that. And then I know I'm doing well. If you throw the ball down and it keeps hitting the bumpers going all the way down, that's a lot of volatility, and you're losing your likelihood that you may hit the 10 pin.
You just did a bowling analogy. You know what they call bowling alleys now, Gary, don't you?
No, what?
They call them condominiums because they just tear them down and build condominiums. But fortunately, my listening group out here, listeners across the fruited plain, they understand what a bowling alley is and probably have actually been in one. Now, for you youngsters out there, look it up, Google it. But I think that's a good analogy. Just people got to remember, it's a fixed annuity. You're not going to lose money. The downside is 0.
Right. Exactly.
I hate it when people say 0 is your hero. No, 0 is not your dang hero. That's the dumbest statement. If anyone ever says that to you, get up, walk out, just hang the phone up. That's just such corn pone nonsense. Indexed annuity, slap your mama junk. Okay, I'll get off my soapbox. Okay, what's the
So,
other
that's why, and
innovation?
then there's the second innovation is, and where there's a lot of activity, is what they refer to as a registered index linked annuity, which is really, you could say it's more of a variable contract. And what
Sure.
that really means is that I'm widening those bumpers. So maybe I have a higher likelihood of making 5 or 6, but in return, the trade-off is maybe I'll lose a little money. Maybe I'll lose up to 10% of my principal. So
Are these
again,
also called buffer annuities, Gary?
yep. Well, I
Buffer,
know there's so many different names for them right now.
shields,
So,
buffers. You know,
but basically all it's doing is widening it's widening the top and the bottom. And because you can maybe lose a little bit money potentially, you also have a likelihood of making a little bit more. But
of
again,
course.
it's, again,
I call them copay annuities, just because that's what they are in
right.
English.
So I guess that story's kind of resonating a little bit, especially in
Yeah, it
the
is.
advisor community. So I think that's why. So I would say there was probably 18 months ago, maybe a half dozen carriers that had one of those registered index link annuities. But I think by the end of this year, you may see up to maybe 2 dozen. It's really
Very
starting.
interesting.
Yeah.
Well, I also think that's a reflection of the broker dealer space, which I dominated for a long time at Morgan Stanley, Dean Witter, Payne Weber, UBS. But they're now bringing in annuity products, and bank channels are bringing in annuity products, and registered investment advisors, masters of the universe, are grasping annuity products for whatever reason. Do you think that's another reason for the growth in the annuity sector, because the distribution channels are widening as well?
Yeah. Yeah. I mean, I think you hit on the head. I think the second biggest thing that we see is that the industry is making a concerted effort to make annuity products more mainstream for a
Mm-hmm.
financial planner. I think, really up to this point, it's been a specialist game. And, as far as the breadth of adoption, and it's
Mm-hmm.
just not the consumer, but it's breadth of adoption of the advisor as part of their practice. So
Mm-hmm.
you're seeing a huge amount of money and investment by firms to make an annuity as not only as easy to understand for the advisor, but to help advisors configure these products. And maybe if you can give me like a few minutes here to explain what I'm talking about here. You could either buy a real simple annuity, and I think that's a lot of your story, your value, right? Just get the contractual guarantee.
Mm-hmm.
Just give me the guarantee. A MIGA.
Well, we have a handful of indexed annuity carriers that fit my parameters for
Right.
potential growth. But
Oh,
it's a
absolutely.
handful. There's not a lot, believe me.
No,
Because
it's a handful, and I think in your case though, it's because of the guarantee on the income rider, in many cases too.
correct, but
Well, as opposed to the commission.
but we have. I tell you what's happened on our end too is we've seen carriers develop better index option, pro consumer index option choices, to where we're helping people go in that lane as well. So they might do if they want accumulation, we might do a MIGA ladder with an indexed annuity on the back end, just
Right.
because there has been a change in what carriers are offering. I think carriers have listened to people like me and say, you can't just throw it out there. You can't just
Yeah.
throw it out there and see what sticks. You have to bring something that brings value. And I
Yeah.
think it's great. I think the consumers are driving that, and they're dragging these annuity carriers across the finish line to give them a better product.
Yeah. Oh, and really that is what's going on. They're trying to add as much value out there, and they're trying to compete against each other too. So
Mm-hmm.
the challenge with an annuity sometimes is that when you're adopting as part of maybe a more complex financial plan,
Mm-hmm.
or estate plan or retirement plan, an annuity can be configured to fill the gaps and the slots within that plan. So it's just not a one size fit all. So when
No,
you think
it's
about
not.
an annuity contract, you have the opportunity to get like 4 different types of protections.
Mm-hmm.
But you're filling the gap in a plan with maybe one or two of those protections, and you need to know how to configure that contract. So those protections are protection against Uncle Sam, right? As
Mm-hmm.
far as the tax deferral, if that's a main objective. Another one is protecting your principal,
Mm-hmm.
not guaranteeing, but protecting it. A third one's death benefit. And of course, the fourth one is an income benefit. So
Mm-hmm.
depending upon what gaps you're filling in a broader financial plan, you can take one of these contracts and configure it, right? And so that it fits within that plan, as opposed to the other way around, as opposed to saying the annuity is your plan, right? You're fitting it in. And there's a lot of support and theory around, depending upon different financial planning methods, where that comes to play. The thing is, with what's happening is that there's an increase in tools and support, and we're part of that support too, which allows the advisor to figure out which configuration, not only what configuration of the annuity may work best for a particular plan, depending upon one of those elements, but if I know that I'm going for something that's going to have, the best type of protection or an allocation of investment options within that annuity, I need to know maybe which one I need to pick in the first place. So to your point, if you're looking for the best fixed index annuity in your case, for that type of guarantee, not all fixed index annuities are created equal. You need a process where you have to go in and figure out, okay, which ones are providing the best value for what you're trying to accomplish with your clients.
Right.
So
And what
there's a
we
lot of
do,
tools and support for that.
no doubt. And then there's what we do is, if you say two questions, what do you want the money to contractually do? And when do you want those contractual guarantees to start? If you say income and income later, now we're looking at income riders and the product immediately becomes a commodity of which we shop all income riders. But if you say principal protection with, the G word, growth, then it's not a commodity anymore. You have to then do the analysis to make sure, and that's the reason there's only just a handful that our team and our staff have deemed appropriate and suitable for people. And it really it's that complex on the index annuity side. You just can't buy an index annuity. They're not all made the same. You can, if you want income in the future with an income rider, then let's go buy an income rider, because that's always going to be the highest valuation on that policy. So what else is kind of new that you're seeing out there, Gary?
I think the third thing is there is also a lot of focus and investment in making simple annuity solutions available at the workplace, either within the 401k or as a rollover option now the 401k for plan participants. It's weird. I think once the government about 2+ years or so ago passed a bill called the Secure Act, which kind of provides some cover for the plan sponsor or the employer as a fiduciary and providing some annuity options to their employees.
What it did was shelter them from a fiduciary rule.
Yeah.
Because in a fiduciary setting of which we live in, you're quoting all carriers for the highest contractual guarantee. We're showing all carriers. There's no agendas. There's no, hey, I got to sell this because I want to go on a trip to Bora Bora. It's you're putting in front of them the best contractual guarantees. What the Secure Act did when you have your 401k or your plan at the employer, what they did is they said, yeah, you don't have to show all the carriers, but you have to show a few. Yeah. I'm not sure I'm a big fan of that. I understand the logistics of it. But what that then comes down to is now you have the big boys buying into the platforms to be shown by the plans, which I don't think is perfect all the time. But, nothing in life is perfect, Gary, except your trombone playing when you're in the band, because he isn't a musician, by the way, on the side.
What's interesting is that, rather than showing multiple options to the plan participant, it's the employer or the plan sponsor who has to make a decision on a product. And some of these configurations can be a little bit more complex because if you ignore what's going on under the hood, they're trying to provide an allocation option within your 401k where you're buying units of a pension over time. And they're making this available more to, say, the middle market, not necessarily mass affluent or high net worth or folks that have the ability.
I'm all for it. I think it's great because the more people understand that annuities are the only product that can provide a lifetime income stream like the annuity you already own, i.e. Social Security, the better the annuity industry is going to be because that's the monopoly that the annuity industry has, which is lifetime income.
Right.
There's no ROI until you die because they're going to pay as long as you're breathing. I think this is a good foundational educational step that the industry has been drug across the finish line. I think that the annuity industry is going to be successful in spite of themselves just because they're in the way of all this,
Yeah.
period.
Well, I think they're learning and they're getting better and just figuring out where the sweet spots are. But I think at the same time, even though there's complexity being introduced, I think the simplification or applying those in a much more simple manner is improving as well. So, I mean, heck, if you think some of the advisors are like deers in the headlights trying to figure out all these new types of annuities coming on the market,
Right.
just imagine trying to have that conversation with the head of HR, right? You know, for the company plan.
Right.
You know,
And the limited choices on a 401k type plan where they're offering a lifetime income product internally. I mean, the problem I see with the industry is, at the banks and at the brokerage firms and at the large places like Fidelity, they have a limited offering of annuity companies. I mean, they have 5 or 6 or whatever.
Mhm.
That's not bad, but it's not perfect.
Right.
So you just have to know that if you're a client of one of these big banks, brokerage firms, online brokerage firms, you have to understand there's a limited amount of carriers that they offer. They're not offering everybody. They'll have a story of the reason why, but the reason, it's a pay for play. These carriers typically, to get on those platforms, typically, not all the time, there has to be some type of agreement between them and the bank brokerage and online brokerage to do that. Once again, I think overall it's good because people are getting more educated on the product, but I think they start finding out that it's commoditized pretty quickly once you're looking at lifetime income or just, a fixed rate annuity. It's the potential, hypothetical, theoretical, projected, back tested nonsense that starts muddying the waters and filling up the bad chicken dinner seminar attendance list.
Yeah.
Which
Well,
is,
you bring up another interesting point. I think historically, and because of those limited shelves, if you will, or products available at some of the larger firms, I think that was a function of maybe the lack of technology or tools to allow advisors to figure out how to work with a broader set of annuities. So in the old days, let's face it, typical financial advisor without these tools or technology, they'll just go with 3 types of or 3 products or carriers that they're more familiar with. It's like the car shop, right? You walk and say, well, I only tune up Fords and I only tune up Chevys, right? But now, in the old days, remember the commercials like, wow, foreign car, never tuned one of those up before, right? So I think with technology now, you have the tools and the capabilities maybe to go across all the makes and models to be able to figure out what's inside and maybe make it click. So I think that's where the industry is investing into. But you're right. I think that there's still a long way to go for some of those firms that open up to more products available to their advisors.
And once again, we're talking to Gary Baker, who's the CEO, Grand Poobah of Canex, which is the company that's the leader of this. So when he talks about technological advances, he's being very modest. He's talking about Canex. He's talking about them. And what's happening is the banks and the brokerage firms and these big people are coming to Gary and his group and saying, build us this objective platform so that we can analyze the products real time, which then what Gary's actually doing is helping the industry by providing these objective platforms so that these new people to the annuity world, the bankers, the brokers, the RIAs, are looking at it from a more analytical standpoint, not just, hey, we have this carrier, let's see what they do. Because Gary's company, which I love about Canex and Gary, is there's no favorites from this. I mean, of course, I'm his favorite, but that's okay. But there's no favorite from a carrier standpoint. They're just putting in data. They're a data company that provides real-time data for us out here to either provide real-time quotes or in some cases with RILAs and indexed annuities to provide real-time analysis. Did I get that right, Gary? Am I hired
Yeah.
as your PR firm?
Absolutely. And so we support a lot of third-party applications who have different processes to support selection or modeling or allocation within those products. And we support a lot of that functionality behind the covers, or under covers or behind the scenes for them to do that. So really, you can run any type of electrical current you want through the product just to figure out whether or not it's going to configure or align with what we're trying to put together for the client.
I just wrote down behind the covers because I really believe that's going to be a good song title of our band when we finally put together the band, because
I think I mixed up two analogies on that.
It's a combination of under the covers and behind the scenes. So behind the covers will create confusion, of which I love. So I'll work on those lyrics, Gary. We'll put together the thing.
Good.
One of the things that you said early, and I wrote it down, is you kept referring to annuities as contracts, and which is on the money. Because if you don't believe annuities are contracts, buy one. Guess what you're going to get in the mail? It's called a policy, but Gary and I call it a contract. So these are contracts that you need to understand. And if you're looking at one of these RILAs or index annuities and you don't understand it, ask the person, hopefully it's me, for that specimen policy. We can get you that. We can get you whatever you need to read before you sign the paperwork. Don't buy the sales pitch because you're going to own the contractual reality. So I thought that was key when you just instinctually call it a contract, because it is. And I think that's a distinction that needs to be made over and over out here. We do that, but too many times people are looking at these as investments. They really are contracts. You just have to understand how that contract works. What else is new out here, Gary?
No, I think those are the three big things that are keeping us busy, or that we see generally in the industry, as far as, again, the big introduction of more and more index products, more technology and support to advisors so they can sort through and configure these contracts. And thirdly, the pension, defined contribution, pension replacement at the work site. So that's keeping, those three things are keeping a lot of people busy these days.
Tell the people what RILA means. What's that stand for?
Well, it's registered index linked annuity.
Right.
So so if you were to, it's very confusing because you have to be a registered rep to sell that type of index annuity, because of the opportunity that you may lose a little bit of your principal. If you got that compared, so you can say, well, why isn't an FIA called a fixed index linked annuity? Well, you could probably call it that too. So
there's arguments for that being a security as well, right? I mean, we've been through that.
Oh yeah, but you can't go below zero, right? From that standpoint.
That's true.
We don't have any opinions on that gray area or that food fight going on.
No, and that's what I love about what you guys do at Canex, because you're providing the data points and the real-time data that you are getting from the carrier on the carrier's product to then provide to the advisor to make the analysis. Do you ever see a time, Gary, that type of analytical information is available to the public?
I don't know, in the same way,
And if not, why not? If it's no, then why?
I think for some reason you want to go to a doctor as opposed to go to WebMD every time you feel an ache in the
but people go to WebMD though. That's my whole point.
They end up going to a doctor.
Yeah, but that's my whole point though. We are in a society where, good or bad, but it's you can't put the toothpaste back into the tube. Right. Of where people want to do their own research before they go into the doctor.
Yeah, no, I granted, we've sponsored a lot of research over the years as far as what consumers want versus what financial advisors think they want. They certainly, financial advisors actually underestimate what consumers want. But, in a lot of cases, the annuities, there is a large section of investors or consumers they'll go to somebody who they may want to trust and say, oh, this is so confusing. You just tell me what to do. On the other hand, there are investors out there that want to know. They want that research.
Yeah.
And the question is, how do you package that in a way where, you can at least have a simplified experience, publicly for them to go to a website to do that type of research.
It's called Canex to Consumer, C2C.com. No, it doesn't exist, but
now we rely on folks like you to do that.
I understand, and I think we're going to eventually get there to where we might just do that. We might just provide that analytical tool. We provide everything else. The last piece is to provide the analytical tools that you are offering. The only thing is will you allow us to do it when that time comes? I think we're a couple years away. But once again, the great part about what's happening in the annuity industry, in my opinion, obviously you have pioneers out here like me that are taking all the arrows and doing a direct consumer model up to the point that we legally can, meaning that at the end, someone with a license they do have to talk to you before as you're filling out the application. But eventually that won't be the case. I think that the great part that's happening in the annuity industry is the consumer. They are molding the products. They're molding and demanding how things are going to work. They're molding and demanding transparency. And that's always a good thing when the consumer runs it, not the companies, in my opinion. Do you agree with that statement?
Yeah, and I don't think, and to get to that point, I don't think you focus as much as the product or the engine under the hood. You're molding a solution based upon a need, which may already allocate across an annuity plus something else, right?
Mm-hmm.
And so rather than trying to explain to everybody on how the pistons work and the spark plugs, if you will, they just know that, when you look at the ingredients on the back of a soup can, you know that it's, equal parts of this, that, or well, maybe not so equal parts, but,
Mm-hmm.
You can see what the ingredients are, behind the scenes. And I think as far as for the general public or consumers, being able to mold solutions that solve a specific need that they have, knowing that behind the covers there's certain investments or contracts that are going to support that need. So I don't think you're going to get anywhere trying to explain to the public why one index annuity product's better than the other.
Mm-hmm.
It's a matter of what gets configured under the hood, and then what are you actually solving, ultimately at the best value.
Recently, Gary, there was a carrier that we will not name that pretty much came out and said in a press release that they're no longer going to be focused on the guarantees of an annuity. They're going to be more focused on potential hypothetical, theoretical, back tested, hopefully unicorns chasing the butterfly stuff that drives me crazy. But they're doing that for profit reasons. It's very obvious. Do you see that as a canary in the coal mine and as a trend going forward? Because, annuity companies are for profit. There is big money coming in who demand returns. Do you see that being a trend, or are they a one-off?
I don't necessarily see it as a trend. Insurance companies have been around for hundreds of years, and they're pooling risk at the end of the day. And they've gotten really good on how to manage that risk on behalf of the investor. Now, that being said, there's different flavors of insurance companies that support these contracts. You have the ones that are stock owned, you have ones that are mutual, owned by the policyholder.
Sure.
And there is, there's a reason why you have those ratings out there. I mean, AA, AAA, still means a lot, when you're looking at that, and because they're managing the reserves appropriately. But that being said, there are some firms that are looking to, increase incrementally their profit margins. You do have some carriers now today that are going offshore.
Yeah, that's a concern.
And you have a lot of these equity companies that are buying up some of these insurance blocks and maybe looking for some of that incremental return. So that seems to be something that's happening a little bit more and more. In fact, you're seeing some of these larger insurers even dipping their toe into those waters. But I think it's a matter of how do you not only how you make a product more efficient, but how you keep the balance sheet more efficient in the background. But I don't think it's going to be anything that's going to remove an insurance carrier from providing these guarantees or protections. They're just looking ways to maybe make it more efficient. But for somebody to completely back out of hedging their costs for offering any type of a guarantee, I think that's just more of a one-off business decision of that firm.
Got it. Well,
I mean,
I had Kerry Pector of he's the editor of Retirement Income Journal, which is kind of an industry journal. And he was talking, he's written an article called the Bermuda Triangle of Annuities, where companies are going offshore, and what Gary just mentioned. Is that a concern that you're hearing people talk about? Because I thought it was very innovative for him to approach that, because that's a you're tiptoeing into some tough waters there, because you have big companies doing that, and I know he got a lot of blowback on that. Is that a concern for these companies, going to Bermuda so there's no regulations? And because at the end of the day, customers are trusting these carriers with their retirement, parts of their retirement. Is that a concern for you, or are you okay with all that?
I guess the real question is what type of transparency is involved in that.
Mm-hmm.
There are services out there, and you can certainly comment on this, which provide a little bit more background on the insurance carrier backing that guarantee.
Yeah, we look
and
at that.
The health of that.
Mm-hmm.
I'm not sure how much these offshore trends are playing into those rankings or those scores. So it's new and developing. It was niche, and now it's becoming a little bit mainstream as far as how some firms are managing their balance sheets. So, I think with that, I think there'll probably be more, a little bit more light shown on that, and the regulators maybe digging a little bit deeper. And I think maybe there'll be some adjustments or views on how that ends up on how you score or would rank or rate, insurance carriers, depending upon how much they're going offshore.
I just hope that the industry is very, very proactive on that instead of being reactive. Reactive is we're having a problem and then solving it. I'd like for them to solve it before there's a problem. That would be, because it's obvious it's something that we need to look at as an industry, because up until a few years ago, this was an old stodgy travel agency type model of how annuities are sold. Now the smart people and the Wall Street people, and then private equities and the investment banks and the family office, all those people are starting to look at it because they want to get in front of that demographic tidal wave. So what you're going to have a bunch of sociopaths with a lot of money now in the annuity industry, which isn't a good combination. Fortunately, the annuity industry has really good oversight and regulations in place. I always tell people they're not smarter than banks; they're just more regulated, in my opinion. Which is why we haven't seen a lot of issues. What other whispers are you hearing out there, Gary, without mentioning names and carriers, that, in addition to interest rates being low, perceived low, and when I say perceived low, everybody, this could be the new normal. Hopefully it's not. But for the last 6 years, all I've heard from people is, well, rates have to go up, Stan. Rates just have to. They don't have to. Okay. What other items are you hearing out there, if anything?
As far as the market itself,
the annuity industry. In addition to what you've already said, what's the concerns? I mean, what are they? Obviously, they're happy because there's so many people turning 65 looking for guarantees and looking for income and that type of thing. But what's keeping them up at night, if anything?
Well, I'm sure a lot of things. Beyond the things that we just hit upon. I can't think of anything else, that, outside of maybe just one-off things here and there for a number of firms. I mean, at the end of the day, it's a competitive industry.
Yes, it is.
And there's a lot, there's a lot of insurers out there, and there's a lot of people with product out there, and and even firms. Foreign owned firms or firms that operate in other markets looking to get into the U.S.
Yep.
So I think competition will continue to intensify. So,
and that's always a good thing. I think the consumer's the winner on that.
Yeah. I mean, but with more competition, then that if you're not good,
Yep, you're right about that, and I do think that if we do have some market volatility that is, that lasts a little bit, it's going to be interesting. I do think if they raise rates, is my opinion, the second they raise rates either one or two times, the stock market's going to react negatively, and I don't foresee them raising it the four times that they're talking about in 2022. I hope they do. That'd be great, but I don't know. Do you have any opinion on interest rates and what they're gonna do here, if they're really actually gonna do what they say they're gonna do? The
I'll
Fed?
probably be working for myself at that point, if I.
No, we need
Well,
you. No, we.
if you think about it though, if interest rates do go up, right? I mean, sometimes when I'm sure when you talk to some of your clients, they say, well, why would I buy one of these things in such a low interest rate environment,
Mm-hmm.
right?
Yeah,
And
I've heard that a few times.
right, so okay, well, does it really change if it's a higher interest rate environment?
If it's a lifetime income product, interest rates play a secondary pricing role. Longevity and mortality credits, drive the train.
Right.
And by the way, your good friend Moshe is going to be on the podcast coming up in May, which we're
Oh,
looking
good.
we're looking forward to that. I just reread his book on Tontines. If you don't know what that is out there, listeners,
Tontines.
it's
Tontines.
no. In South, it's Tontines. It's not.
Okay.
You don't do Tontines. Come on, man. But I read that, and if people don't know what that is, pull it up. Tontines. It's pretty interesting. And so Moshe Milevsky will be on the Fun with Annuities podcast, Gary, which is cool. If people don't know, the Canex and Moshe Milevsky have a good relationship together. Have been working together for a while. He's one of the smart guys in the room. When him, Gary, get in the room, no one else is allowed in because there's no space left for anyone else's brain. For God's sakes, I mean, that's how smart they are. I think I was just thinking about you, Gary, and in addition to you just being a really cool dude and very, very smart and transparent, I want people to understand who's on with us. When you choose a SPIA, MIGA, DIA, QLAC, index annuity, Gary's behind most of those sales. I'd say he's behind 90+% of those sales from the standpoint of data, from the standpoint of the analysis of the advisor or agent or registered investment advisor that's recommending the annuity. Gary's fingerprints on that, and I just want to let you know that's a good thing. I mean, he's, what he didn't do if I was his agent is I would have negotiated a penny or a nickel per policy that he got paid on, and then he would have been, well, we wouldn't be talking to him. I mean,
No, that's
he'd be
true.
rich.
But we don't. I mean, full disclosure, we don't make our money based upon assets or sales.
He doesn't.
We're
No.
Switzerland. We want to stay that way. So.
You're the Switzerland of annuity. You are. I mean, and that's what we love about you. I mean, we get, the quote feeds that we use with you are fantastic and consistent, and we really appreciate that consistency. I know it's easy for us to say that, but it's hard work for you to deliver that. And we do appreciate the services that you're doing. And the other thing I appreciate with Gary, and I think when Canex brought him in, I think Gary was with GE a long time ago, and he's done some stops at some really high level places. When they brought him in, I doubt if they ever could imagine the business model that Gary had adopted at that time morphing into where it is now, to really, in a non-progressive industry, being a progressive part of the industry. That's me giving you kudos, because what you're doing now is really interesting. I think it's going to continue to grow as the government continues to tell people Social Security is not supposed to be the primary income source for you. So what's the future for in 2022? Is Canex just going to continue to block and tackle what they're doing, or have you got new things on the horizon?
Well, we do also operate in Canada. That industry is ripe for innovation. We're starting to see some of the signals coming out of that market for maybe doing some additional things. It's certainly not as diverse and as intense and innovative of what we have in the U.S., but I see some activity emerging in the Canadian market. Unfortunately, in Canada, they don't have the advantage of tax deferral. that you would typically have in the U.S. for annuity contracts, and based upon certain financial regulations, the insurance companies are a little bit hamstrung around income benefits off of some of these, savings annuity contracts. So, so it's
Explain
certainly
that a
not.
little bit when you talk about the
Oh yeah,
hamstrung.
so the accounting rules in Canada are much different than
Well,
whatnot.
your camera just went down. Move your camera back up.
Oh, okay. Sorry
We only
about
see a
that.
little bit.
All right.
We want to see the full Gary Baker, not
Yeah,
partial.
not half of them.
No, not half of Gary Baker. All of Gary Baker.
Yeah, no. So there are different accounting rules and regulations in Canada, which require the insurance company to actually put more layers of bubble wrap around their balance sheet so they can stay.
Wait a minute. You just did a bowling analogy. Now you threw bubble wrap at me?
Yeah, bubble wrap. Why not?
Man, you are the god of middle America, man. They
I
love you.
don't know, but I also confuse and combine analogies too, apparently. So
Yeah, I mean, I like behind the curtains or behind the covers. I'm sorry, behind the covers is the song that Gary and I will be writing after this. It will be a combination love song, punk song, right? Gary, where are we
right.
going with
You
that?
get the verse, I'll get the chorus.
But no, getting back to the Canada, you're saying that Canadian annuities the carriers have to come up with a little bit more back end money, which means less tail risk, right, in the industry.
Yeah,
Do
and
you
so
see?
then it becomes economically not viable to provide something of value back out. You can provide something out, but it's not going to be close to what you can do with other types of
Do you
contracts.
see that trend of additional monies needed for the tail risk? In English, okay. Tail risk would be, hey, I bought this income rider, and this company sold all these income riders. Can they pay the guarantees of that lifetime income stream for all those income riders if someone turned them all on?
Yeah.
That's the definition.
And if they all lived at 90, 95.
Right. I mean, that's the North Carolina, where I'm from originally. Southern definition of tail risk is my friend Chester, the mythical Chester, client of mine, walks up to the actuary and go, hey, these income riders, if everybody you got with an income rider turned it on and lived 100, can you boys back that up? That's tail risk, right? And Chester speak. And by the way, Gary right now is in God's country, North Carolina. That's where he is sitting, where we were just talking about North Carolina got snow, which all that means to you, if you're not from North Carolina, is there's no bread in the store. People run to the store with snow, buy all the bread. And I've always wondered what happens to all that bread, Gary.
I don't know. Apparently it goes north. I don't know. Yeah, it was definitely the sign of the apocalypse last week.
Because Gary's originally from Pennsylvania. I mentioned Penn State University. He is just a revered figure in the state of Pennsylvania, and now he's down in North Carolina, and he's becoming addicted to barbecue, which is good. But the snow thing, you mentioned to me before the broadcast, hey Stan, do they not have plows down here? And my answer is yes, they do, but they're on farms.
Ah, right.
Yeah, they're plowing the field, Gary. They're not plowing the roads. So my advice to you, if it snows in Carolina, stay the hell in.
Not the front end, on the back.
As I always do, Gary, I let you, the celebrity guest, end this with advice, insight, words of wisdom, walk away, drop the mic moment. Go.
Boy, I wasn't even prepared for that one.
I know, no one ever is.
Nothing that I could drop the mic on, but not just look, the market's going crazy right now.
Stock market.
And yeah, the stock market, don't freak out. The only people that get hurt on the roller coaster are the ones that jump off. Just remember that.
Wow. There you go. You shouldn't, I mean, that's it to me. But between the roller coaster analogy, the bubble wrap analogy, and the bowling alley analogy, and your song title, Behind the Covers.
I don't know. You have hit it.
You've hit it out of the park. But all kidding aside, Gary, we love having you on. You are, you're a treasure for the annuity industry because you are what it's supposed to be: transparent, honest, factual, data-driven, contract-driven. and your company provides that for my company and so many others. And he's behind pretty much every annuity sale on the planet, which is good, and you should feel comfortable with that. We're just honored to have him as a guest. So I want to thank everyone for joining me on the #1 annuity podcast on the planet. Just happens to be called Fun with Annuities. I'm your host, Stan the Annuity Man, and we will see you again next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.